Okay, good afternoon, everyone. We have today our second quarter and first half financial results presentation for 2024. Today I'm joined by MAIB CEO Giorgi Shagidze, CFO Makar Stoyanov, and I'm Evgeny Risovich from Investor Relations. We will walk you through our key financial metrics and answer your questions at the end of the call. You can write them down in chat or raise your hand at the end during the Q&A period. Before we begin, I will just attract your attention to some disclaimers that we have. We have some forward-looking statements in this presentation, including expectations, forecasts, other projections that are subject to multiple risks and uncertainties, which could cause actual results to differ. We outlined several potential risks here, including macro, regulatory factors, market risks, operational challenges. We caution you not to rely on these projections when making investment decisions. All presented results are based on unaudited financial data prepared in accordance with IFRS standards. Now I will ask Giorgi to please summarize the performance during the period.
Hi, good afternoon, everyone, and thanks for joining us. We continue delivering good results and strong financial results and operational numbers during this period of time. I think if we start with this slide in terms of macro, our GDP forecast for 2025 and 26 will be between 1 and 3%, respectively. Inflation in June was 8.2%. In July, it went down slightly to 7.9%. With regards to our strategy, we continue increasing our MyBank users to up to 850, almost 850,000, with already 1.5 million cards, and with our deposits and loans granted through mobile banking close to 80%. In terms of financial performance, our return on equity for the full first half 2025 was 20.4%, very close to second quarter 25 of 20.5%. We had strong loan growth of 33% year on year, and we will discuss all this in more detail on the next slides. Evgeny, let's move on. You are on mute, Evgeny.
Sorry. So we will first go to macroeconomic and country updates, then back to Giorgi with bank's overview and strategy execution, and then Makar will talk about the financial performance during the quarter and a half. Just a few words about macroeconomic performance. GDP of Moldova has had a negative performance in the first quarter. Second quarter results are not yet available. The contraction in the first quarter was 1.2. Seasonally, this is the lightest quarter, and really the majority of the GDP comes in the third and the fourth quarter. So it might not be an indicator of the overall economic performance. As a result, we have seen a number of downward revisions of the forecasts, including the Ministry of Economy, which now estimates GDP to grow by 1.3%. Previous number was 2.1%. Overall average prediction for Moldovan economy from range of forecasters, including the World Bank, EBRD, and others, is 1.1 for 2025 and 2.8 for 2026. Most of them have revised the GDP forecasts down recently, mainly in response to global economic headwinds. Moldova has seen some very negative impact on some of the key sectors of the economy, that particularly the ones that are involved in international trade, such as agriculture and also automotive sector. Against the backdrop of higher energy prices in the beginning of the year, inflation pushed upwards at the end of 2024 and the start of 2025. Most recent reading for July has been 7.9, following a high of 9.1 in January. NBM inflation outlook points to inflation returning within the target corridor by the end of 2025, supported by several disinflationary factors such as decrease in the commodity prices, among others. National Bank of Moldova kept interest rate at 6.5% in the second quarter. Most recently in August, so this is already third quarter, the interest rate has been lowered to 6.25. Again, the start of the year saw two consecutive increases from 3.5 to 6.5. And now with disinflationary outlook, National Bank is expected to continue lowering interest rate and stimulating the economy. In terms of currency trade and reserves, the currency has been more or less stable against the euro. We've seen in the global market decrease of USD to euro exchange rate, hence the drop of USD exchange. Reserves since the beginning of 2025 have been denominated in euros, and they have remained rather stable since the beginning of the year, 5 billion euros. However, in dollars, as we've seen depreciation of dollar against the euro, reserves have grown to 5.9 billion. This is about 7 months of imports, and the stable reserves in euro reflect a rather large current account deficit that Moldova has encountered in the first half. I see a raised hand, and we will address your question at the end of the presentation, if you don't mind. So, in terms of the trade, Moldova has seen 30 consecutive months of declines in goods exports. Again, this is driven by weakness in two major sectors: the agriculture, which is the largest by far exporting sector, and also automotive, which is affected by decline in the European automotive industry, which Moldova is a big part of. Now, in terms of net services, they have continued to grow. Net exports, mainly driven by sustainable good performance of the IT sector. Ministry of Economy, according to their forecast, expects the agriculture to rebound in Q3 and Q4. In terms of the budget deficit, it remained rather modest at 2.3% of GDP. Overall debt to GDP stands at 36%, which is relatively low by the standards of the peer group countries. Just a few words to mention on the political and country level. So EU has started disbursing the funds under its ambitious Moldova growth plan of 1.9 billion euro over a 3-year period. First tranche has been made of 270 million euros in Q2. And we expect another tranche by end of the year. Again, we should see this package come in handy in terms of stimulating the economy, and most forecasters predict a Moldovan economy to grow at 4 to 5% in the long run. Banking system has seen a significant increase in loan to deposit ratio, mainly driven by a lower interest rate prevailing in 2024. It has led to increased mortgage lending and also increase in consumer lending. Some of the key upcoming developments, just to mention, Moldova Business Week starts on the 15th September. It's one of the largest trade and investment events in Moldova, with presence of all the major government officials, and there are also elections, parliamentary elections upcoming at the end of September. Now back to Georgi to talk about banks' major events and business.
Yes, thanks, Evgeny. Basically, a little bit about MyEBay at a glance. We are at 35 to 37% or 38% of market share across various products and services, depending which one you choose to assess the market, with about 1.1 million customers in retail, 1.5 million cards. We'll see the performance numbers, but again, 20.5% return on equity in Q2, with the improvement in cost to income to 46.6%, and all this happening with the very strong liquidity and capital adequacy numbers. Next page, Evgeny. Our strategy remains the same, put the customer at the center of everything we do, to continue transformation and adding many digital service product and services, as well as continue exploring opportunities in Romania through asset-light startup like investment, which we have been granted permission from National Bank of Moldova to apply for the license to National Bank of Romania. Next slide. Here we have highlights and achievements in Q2 2025. We continue financing the key projects for Moldova. In Q2, we financed 50 megawatt the solar plant, one of the largest or the largest such plant in the country. And by the way, we have the green and solar initiatives in the bank as well, which we continue disclosing step by step. We have few upgrades in our mobile bank when we provided access to Moldova, to our app, to the citizens living abroad, and enabled the international number. We recently launched the new design in the app, and we continue basically surprising our customers in this regard. In terms of awards, I think one very important award that we received was Bank Assurance. We've been named as the most innovative bank in Central and Eastern Europe by Global Finance in Bank Assurance, and Euromoney Award for the best corporate bank in the country. Next slide. So some more about our digital numbers. We grant about 82% of deposits and 78% of loans through our mobile bank. The monthly active users remain at 68%, of the daily active users at 37%. Based on the third-party research, we basically strengthened our position in the banking to be number one in top of mind, the best in net promoter score, and overall in the country in loved among the loved brands, we have the ninth place. Next slide. This is a little bit of summary of the financial performance. Makar will continue in detail. Profit for the first half of the year increased by about 19% year on year. Return on equity increased the first half by 2.1 percentage point to 20.4%, and quarter-over-quarter increased by 0.9 percentage point to 20.5%. We have improvement in NIM to 5%, mainly related to inflation and NBM increasing the interest rates, and that triggering the increase in the interest rate in the country. Cost to income for the quarter was 46.6%, and our liquidity ratio and capital adequacy ratios were at 164 and 19.7%, respectively. Makar, please.
Yeah, thank you, Giorgi, Evgeny. Good afternoon, everyone. Indeed, let me reflect on our evolution of financials a bit more details. So Q2 was another quarter of successful, strong and healthy growth across all the business lines, retail, BB, business banking, corporate, and the products. If you look on the loan portfolio and deposit portfolio, we kept market share on the loan portfolio. We slightly increased on the deposits ones. And you see growth across all the business lines. Year-on-year growth of loan portfolio is over 33%, with the quarterly growth 7.5%. And that is driven primarily by retail, which increased by close to 10% on a quarterly basis and over 50% year-on-year, but also strong performance of SME, which was over 8% growth on quarterly basis, and the corporate, which also reached over 12 billion portfolio and increased by 4.5% quarter-on-quarter and 23% on year-on-year. That was funded by a strong, diversified, loyal set of clients with the deposits. You see slight decrease quarter-on-quarter of -0.3%. That comes mainly from some big corporate clients. But if you look on the retail side, it continued strong increase from 27.5 billion 3 months ago to 28.7 billion in Q2, which shows that kind of that trust which clients give to the bank and keep their savings and economies with us. If you go to the next slide, you will see that is also we see the increase in portfolio on the net profits over 6% to 426 million MDL in Q2, which is 23% above what we have had 1 year ago. And ROE also over 20% in Q2 2025. That rise is driven primarily, and you will see later, as was mentioned, by increase in net interest income. But also we've seen a strong sustainable growth on the FX portfolio, so kind of the Forex, and also fees and commissions. And that reflects also the performance of the strong growth which we have behind, we see in the profits. If you go on the next slide, you will see that our net interest income is up by 8.7%. And it's driven by both, by increase of the interest earning assets. We've seen that 7.5% increase of the loans, portfolio, and the total balance sheet has increased. But also we managed to get net interest margins to 5%, up by 0.2 percentage points 1 quarter ago, and by close to 1 percentage points 1 year ago. We also see, of course, increase of cost of funding compared to the last quarter, and that is a result of the repricing of the deposits or liability side, which has some lag compared to when the interest rates started going up around half a year ago when the energy crisis hit and the National Bank increased the interest rates. But again, if you compare to a year ago, it's still 0.3 percentage points, cost of funding, I mean, is below. You also see yields on the loans and securities. If you took on the securities, is an upward trend to 5.8% compared to the quarter ago, and also some upward trend in the yields of loans. Again, that's the same story that the channels through which the increase in inflations and the increase of the interest rates or base interest rates going through the loans and liabilities takes 3 to 6 months lag. If you go to the next slide, you will see that our non-interest income has also increased. The downtrend of 7.7% versus last quarter is explained only by one-offs. In Q1, we have sold our old HQ, and that kind of one-off event. But if you look on the Forex or fees and commissions, we see sustainable growth quarter by quarter, year by year. And that exchange gains, for instance, by itself increased over 17% quarter on quarter. And that comes from both, or mainly from the increase of volumes, but also the margins or bid-ask spreads, which we are managing very tightly. On the yearly basis, if you look on the fees and commissions, it also has upward trend, let's say 10% on quarterly basis and 9+% on the yearly basis. If you go on the next slide, you'll see the kind of how critically we approach our operating expenses. Our cost-to-income ratio, as was mentioned, has improved to 46.6%. If we compare to the previous quarter, here also important driver was the expenses with a resolution fund, which we paid at the beginning of the year. But even with the inflation of around 8-9% year on year, we managed to keep the cost under control. The 15% increase of operating expenses versus last year, it's explainable mainly by adjustment of the salaries and the kind of number of FTEs, which increased by around 6%, and the salary adjustment which we have for the part of the bank in the first part of the year. But a strong and stable and improved cost-to-income ratio shows kind of efficiency which we are focusing at. Now, all this, of course, cannot be done without healthy portfolio. We've seen that cost of risk increased to around 1%, and that comes mainly from the fact that in Q1 we have had important recovery from corporates. So if we take that out, we will see it's stable around 1% cost of risk, so it's explainable. NPL reached or went down by 0.8 percentage point as versus last year, and 0.4 percentage point last quarter. And that is driven from one side to organic growth of the portfolio. We've seen 7.5% quarter on quarter, and strategic write-offs of part of the portfolio. And that is all in the context of very strong coverage ratio, over 307% or 300% on NPL coverage, and reserve ratio or ACL coverage ratio of 3.5%, which gives enough kind of stability and buffer in case of kind of worst case event, which of course we don't expect. If you look on the next slide, that all brings us to the key capital and liquidity ratios. Capital is 19.7%, and Tier 1 is 18.3%, both with a good margins above the minimum requirements. The growth of the decrease of the capital adequacy ratio versus last quarter or last year is mainly driven by increase of loan books. And as a result, kind of the exposure, RWA, risk-weighted assets. But at the same time, important to highlight that our RWA density has slightly improved, and we are managing it very tightly. Now, if you look on the liquidity coverage ratio went down by close to 80 percentage points, and that was a decision of National Bank in the context of optimizing the liquidity and the type of investment in the money market which we have been making last month to optimize interest rates income or interest income in the context of decreasing interest rates both in the MDL but also in foreign currency markets. I think that's it on the financial side. Thank you.
Okay, thank you. Thank you, Makar and Giorgi. So we will go to the Q&A, and there's one raised hand. So Gabriel, if you could ask your question, please do it.
Yeah, maybe it's just a mistake.
Okay. Well, we have a question on email, and it's about NPL ratio, which is at 1.1. It is low by historical standard and by peer group standard, considering that macroeconomic conditions have been quite challenging. What is the expectation for, what is the reason for such low NPL, and what is the expectation going forward?
Well, we had I understand this is low. We had few recoveries, which basically were driving this NPLs down. And then you may remember that we also basically make the write-offs when needed. Still, we keep the provisioning levels up to 4%, so we are not releasing the provisions, and we are extremely well provisioned from this regard. Going forward, the NPLs around or below 3% we consider normal NPLs in the country, even though we don't anticipate any dramatic worsening the NPL levels. So the key is that we keep the provisioning constant, and we operate within our appetite of up to around 3% NPLs.
Okay, thank you. With 80% plus retail deposits and almost 80% retail loans online, do you see any room for improvement in terms of digital penetration?
Further improvement, maybe this is what it meant. 80% is a very strong number, and I think it's one of the best number for the traditional, for the not online banks across the region. I would say many countries around Moldova. So this is very strong number and very good place to be. Can we increase it further? Maybe yes, but maybe material increase from 80% is not to be expected, because there are still people coming in the branches and so on. So we'll see some increase in the long term, but we are already at a very strong level.
Okay. So there's one question on chat. Do you see impact on asset quality from underperforming sectors of the economy, in particular construction and real estate?
No, and we don't see, so at this stage, we don't see any negative impact from construction or real estate. In fact, we are quite selective in both construction and real estate, and then we don't even we try to be not enter into relationship where any meaningful stress test leaves the number stretched. So at this stage, we don't see it. We also expect that the sectors will recover in parallel of positive GDP growth for the full year, this and next year as well. And if you take longer term picture, we see lots of potential and opportunities in real estate in the country. Driven by many factors, because of the fundamental need to increase the number of squares available for the population, as well as integration with the EU and so on. So in the short term, we are very selective. In the long term, we believe that the sector has lots of potential.
Okay, maybe another 20 seconds if there's any more questions. So there isn't any more question. This concludes our presentation of half year and Q2 results. Thank you very much, and hope to see you here next time.
Thank you.
And thank you, finance team, for preparing the report and presentation.
Thank you. Thank you.
Bye.
Bye.